Most people think a strong economy begins with people spending money. But what if a growing share of that spending isn't backed by income at all? What if it's backed by promises? Walk through any shopping mall, browse any online store, or scroll through social media, and everything suggests confidence. Restaurants are full, airports are crowded, concert tickets sell out in minutes. New cars keep appearing on suburban driveways. On the surface, America looks remarkably resilient. For years, economists have pointed to consumer spending as proof of the country's economic strength. Household consumption accounts for the majority of U.S. economic activity. As long as Americans continue buying, the economy appears healthy. But that raises an uncomfortable question. What happens when consumers aren't spending because they're earning more, but because borrowing has become easier than ever before? That distinction changes everything. Because behind record spending sits a financial system that has quietly transformed debt into something almost invisible. Borrowing no longer feels like taking out a loan. It feels like clicking a button. And that's exactly why millions of Americans may appear wealthier than they really are. To understand how we got here, we need to stop looking at what people are buying and start looking at how they're paying. For decades, debt carried a certain psychological weight. Applying for a loan meant paperwork, bank visits, credit checks, and long approval times. Borrowing money felt significant because the process constantly reminded you that the money wasn't yours. Today's system works very differently. Buying a $500 television can take less than 30 seconds. Splitting payments happens with a single click. Credit increases arrive through an app notification. The friction that once slowed borrowing has almost disappeared. Technology didn't eliminate debt. It eliminated the feeling of debt. That subtle change has reshaped consumer behavior more than most people realize. Instead of asking whether they can afford something, many shoppers ask a different question. Can I afford this monthly payment? It's a small shift in thinking, but across millions of households, it creates enormous consequences. Companies recognized something fascinating years ago. Consumers hesitate when confronted with a large price tag. Divide that same purchase into smaller payments, and the resistance almost disappears. The total cost never changed, only the presentation did. It's the financial equivalent of making a steep staircase look flatter simply by adding more steps. This idea has fueled the explosion of short-term financing. Buy now, pay later services promise convenience. Retail financing promises flexibility. Zero-interest promotions promise affordability. Individually, these products aren't necessarily dangerous. Collectively, they create something much larger. A culture where nearly everything can be financed. Phones, furniture, vacation packages, designer clothes, groceries, even food delivery. Debt has expanded far beyond major purchases. It has become woven into ordinary life. And because each payment appears relatively small, many consumers never experience the psychological discomfort that traditionally accompanied borrowing. This creates an illusion. Income appears sufficient because monthly obligations remain manageable until they don't. Imagine carrying 10 subscriptions that each cost $20 per month. Individually, they barely attract attention. Together, they're $200 every single month. Short-term loans work in much the same way. No single payment feels overwhelming. The accumulation often does. And that's where official economic statistics can become misleading. Economic reports are excellent at measuring spending. They're less effective at measuring financial stress building beneath that spending. Retail sales rise, GDP expands, corporate earnings improve, investors celebrate. Yet those same numbers reveal very little about whether consumers paid with cash, savings, revolving credit, installment plans, or multiple overlapping financing products. Money entering a cash register looks identical regardless of where it came from. The economy records the purchase, it doesn't always capture the pressure behind it. That's why healthy consumer spending can sometimes coexist with rising financial vulnerability. Both can be true simultaneously. This creates one of the biggest misunderstandings in modern economics. People often assume spending equals prosperity. Sometimes it does. Sometimes it reflects desperation. If inflation pushes everyday necessities higher, while wages struggle to keep pace, households face difficult choices: cut back or borrow. Many choose borrowing because it preserves normal life. Children still need clothes, cars still need repairs, rent still needs paying. Birthdays still happen. Emergencies don't wait for paychecks. Debt becomes less about luxury and more about maintaining stability. The problem is, that stability purchased with borrowing has an expiration date. Every loan represents future income already spoken for. Every monthly payment quietly competes with future expenses. The future becomes smaller because part of it has already been sold. Now imagine millions of households making similar decisions. Individually, each loan seems manageable. Collectively, they reshape the economy. Businesses experience strong sales. Banks generate interest income. Financial technology companies expand rapidly. Investors reward growth. Everyone appears to benefit, at least initially. Because debt has an unusual characteristic. It can increase demand today by borrowing demand from tomorrow. Suppose someone planned to buy a laptop next year after saving enough money. Instead, financing allows them to buy it today. Economic activity increases immediately, but next year's spending power declines because monthly repayments replace future purchases. Growth gets pulled forward. If this happens across an entire economy, present-day strength can partly reflect tomorrow's consumption, arriving early. That doesn't guarantee a crisis, but it does make future growth increasingly dependent on continued borrowing. And that's where things become fragile. Eventually, lenders tighten standards, interest rates rise, employment weakens, unexpected expenses appear. Suddenly, consumers who comfortably managed several payments discover they have very little flexibility left. One missed payment becomes two. Balances begin growing faster than incomes. Financial resilience disappears, quietly, then all at once. History shows that consumer debt rarely creates headlines while expanding. It becomes news only after repayment slows. That's because borrowing initially looks like prosperity. Defaults reveal what borrowing actually was. None of this means debt is inherently bad. Responsible borrowing helps families purchase homes, build businesses, invest in education, and navigate emergencies. Credit has been one of the most important engines of economic growth for generations. The issue isn't the existence of debt, it's the normalization of perpetual debt. When borrowing becomes the default solution for ordinary living expenses instead of exceptional investments, the relationship between income and consumption begins to change. An economy can continue looking healthy for surprisingly long periods. Store shelves stay busy, corporate profits remain strong, employment appears stable, markets continue climbing. Meanwhile, financial pressure quietly accumulates beneath the surface. That's what makes consumer debt so difficult to recognize. Unlike a stock market crash, it doesn't happen overnight. It builds, one payment at a time. One financing offer, one credit limit increase, one deferred purchase, one monthly installment, until millions of tiny decisions combine into a national trend. Perhaps the greatest illusion isn't that Americans suddenly became wealthier. It's that access to credit became easy enough to imitate wealth. For a while, both experiences can look almost identical. The same car sits in the driveway. The same vacation photos appear online. The same packages arrive at the front door. From the outside, nobody can tell the difference between growing income and growing liabilities. But eventually, reality separates the two. Real wealth gives people freedom. Debt gives people options, but only temporarily. One expands future choices, the other borrows against them. That's why the strongest economies aren't measured only by how much people spend. They're measured by how much people can spend without sacrificing tomorrow. Because prosperity isn't defined by purchasing power alone. It's defined by financial resilience when conditions become difficult. And perhaps that's the question worth asking. The next time economists celebrate another month of strong consumer spending, are Americans genuinely becoming wealthier? Or have they simply become better at borrowing? The answer may determine whether today's economic strength becomes tomorrow's stability, or tomorrow's reckoning. If you enjoyed this deep dive into the hidden mechanics shaping the global economy, consider subscribing. Every week, we explore the systems operating beneath the headlines, turning complex financial stories into clear, accessible insights. And if there's another economic mystery you'd like to see uncovered, leave it in the comments. Thanks for watching, and I'll see you in the next one.